Hey everybody, welcome to the weekend video. This is going to be part one of two. We're going to answer some Strat questions here, and going forward on the weekend videos, we're going to have one question we'll answer during the video, and I will be posting a tweet Sunday night, or during the day actually on Sunday, and you can post your question. Whoever's question gets picked will get a free month of Stat going forward, as long as the rest of the team's okay with that. I imagine they are. But that being said, let's get into it. We're going to be starting with these questions. The next weekend video, we'll be going over the setups into next week, and we have a lot of juicy ones. We also have a lot of earnings next week, so it's going to be a very, very fun week. I cannot wait. That being said, let's get started. So the first one is when to expect trades to work against full time frame continuity. The first thing is the premise of your question is incorrect, as trades do not work against full time frame continuity. It can't. And that's why the strat works, because it's what we know to be true. And what your question is more so asking is when the 60 and daily groups start changing control to the sellers while the week and month are green, how do I know if that's actually going to change the week and month continuity or not? And the way you know is, do the signals work, and keep reconfirming. And also, when do those signals occur? Because when things occurs matters, as well as where do those things occur? Because where things occurs matters. And we talked about this in last week's scanner video, but I'm going to bring it back up again because this is a very important concept, and you're going to see this. So, evidence-based analysis. We can either set up signals or trigger signals. When we are setting up signals, we are trading against continuity of higher time frames. We're not trading against full time frame continuity, because if the day is green, it's not full time frame continuity. If the week is green, but the month's red, it's not full time frame continuity. It's in conflict. So when you're in conflict and you have, let's say, the day and 60 green, the week and month red, they're fighting each other, right? And we know this fight occurs in a series of new highs and lows. We have this big broadening formation. So what happens is you'll make the new low. Let's say it has full time frame continuity. The week is red, the month is red, the day and 60 are red in here. Then it goes inside day actionable signal. This is where it shows up on our nightly list, because we draw the broadening formation out. And we say if that signal works, it's trying to go up there. The week at this point is still red, but if this daily signal works, it sets up this weekly signal. So we can take it here to set up the week, and then add on the weekly signal to the upside, thus creating a bigger position. Because if this trade works, this additional signal gives us more reason to add to it, because our signals cause price movement. The other thing we can do is trigger signals with full time frame continuity, which is the less risky trade of the two. Does not mean you can't set up signals. It's just some people will prefer full time frame continuity signals because they have more evidence, period. So for example, this inside day here forms on a Friday. Monday opens, goes inside bar to the upside, daily signal buy. Then it triggers the weekly signal, add to your winning position. And you can add even more, because you can raise your cost basis up into like here. So you can triple the size of your position and still have a break-even stop, which is the key to the strat. Big green trades get greener, thus we can add to them, risking their money instead of ours. So you can see this occurs without full time frame continuity. It's not against full time frame continuity, but without it, and then creates continuity once the new week opens. This one occurs with the week and month already green and in force. So if we go to DE, this is the exact example that you're going to see, and it looks just like this. So we covered when things occur matters, because those signals occur at the end of the week to set up signals and then go in force the next week. Now, where things occurs matters. Since we know it, that fight between buyers and sellers occurs in a series like this, and it's very obvious. Look at how obvious this is. It just occurs. This is how it happens. Since we know it occurs in this broadening formation, what do we then know to do? We know once we've made new highs or once we've made new lows, this is where those counter signals will occur to create signals or cause changes in continuity. So we mention this and we draw the chart like so, right to left. We can also draw from that low, but the week was still open, so we actually draw from the previous range, because the broadening formation is not based on current range, it's based on previous range, which is why it's not hindsight, like everyone likes to say. But if we go to the daily here, if you go to the Wednesday weekend video from 2 weeks ago, you can see us talk about this, but you'll have the inside day. When is this occurring? Because when things occurs matters. This is occurring on a Wednesday. Therefore, it either reconfirms the downside with full time frame continuity by going inside bar down, the day 60 week month red, or it breaks up, negating what we know to be true from the bottom of the range, exhaustion risk, and therefore we would look to change the weekly continuity, which opened here at 360.10 because the week opened here. So anyone short this week, when this breaks up, they have to start covering as price is now going higher. So you can see the day and 60 get immediate control of price action, changing the weekly group, and this occurs on a Thursday, and then reconfirms Friday, going 2 up again. Once that happens, it creates the weekly hammer signal. So we're in from here. And then the 2-2 reversal week occurs above 368.15, and we can be long anytime it's above that. And at the worst, your stop would be down here. What I like to do is go in there on the 30-60 and reconfirm what we see on the week. So intraday, we pointed this out, and this was a $1,600 trade. I think I spent like $687 on the contracts, or maybe might have been a little more. But right here on the 30, hammer rev strat 30 above 371.57. We buy it, it goes instantly, and we hold. And then when there's this 3-2 in here, you can also add. And then there's this big 3, and then they reclaim the 3 on a Thursday. So when this starts occurring on a Thursday, we know we can start reducing position. Why? Well, because this is a 3. So if it's going to reclaim the 3, it's going back down here, 2%, which you can see it does. It's a broadening formation. The other reason is because it has taken out the weekly objectives, which were to make the new highs to this, 384.50. You have the big try in here, but we also have the sub try. So you can see when things occurs matters. If we go to a 60, you'll notice they go 312.60 on Thursday, changing what we know. Inside 60 down, reconfirming that, trying to take low a day, and then they do. And then Friday, 2-2 on a Friday, which is, you're going to see, nowhere near setting up a 2-2 for next week, unlike what occurred here during, I believe that was the second week of the month here. But hopefully you can see how that works. The day and 60 gain control, change what's occurring on the higher time frames, back through a previous range. That's something we're looking for. The next question here is going to be, I'm going to have to skip one by Samuel. I apologize. Your question, I don't quite know how to answer that or what it is. I asked to clarify, but you didn't. This one's important. How can anyone interested in the strat concepts learn it for free? Well, I have multiple series on my channel. There's also this, which was created by the late Rob Smith, and you can see it's very old, but the strat hasn't changed. It's always been the same. This is from 7 years ago. Anyone teaching you something different that's using a lot of the strat concepts probably didn't invent it 7 years ago. So this is it. You can copy and paste the playlist link in here or type it up, but it will be private, so you got to copy paste that. We also do have a strat bootcamp at stratalerts.com. We do that every quarter. The next one, confirming and negating. You're always saying if it confirms or negates and moves quickly, why? Can you spend a little extra time on confirmations? It's very simple. So we're using multiple time frames, which means we will have a 2 on the month if we're trading, or a 2 going 3. They're both 2s though. So if the month is a 2 to the upside, during that month, you're going to have 4 weeks, right? So if this month is going to go up, let's say 20% from down here to up here, the weeks will reconfirm it. They'll trade up the first week. The next week will reconfirm by going 2 up again, reconfirming direction because you have a 2 up month and a 2 up week. So they're buying this month and this week. And then they'll reconfirm again, 2 up again. Then they'll reconfirm again, 2 up again. So this is what a beautiful uptrend looks like. Just 2 up, 2 up, 2 up, reconfirming the month. Why is that important? Because if you watch the scanner video from last weekend, the decoupling sequence tells us this occurs. And we're not going to go as in-depth as the scanner video. I highly suggest checking it out, but I will show you. You'll see this. So the decoupling is we gain information as time goes on. So at the beginning of the month, you'll notice we have the week, day, and month opens. These are the candlesticks just shown as circles, for example. The left side of the circle is the open, the right side is the close. So the day, week, and month open at the same time here. Then the second day of that new month and new week separates that open. So we have a separate daily open compared to the month and week opens, which are still the same. Then the second week of the month and week opens separate. You'll notice the day and week opens are the same right in here. The second day of the second week of the month, we have a separate day open, a separate week open, a separate month open. So what this tells us is price will have less evidence at the beginning, more evidence towards the end. Therefore, you don't have to be the first one into the trade. If it breaks a monthly signal or a weekly signal, you can wait a little bit and let them set up the continuity, then take the reconfirming stuff. The other thing it tells us is each move will either confirm or negate. Because if we gain evidence as time goes on, well, let's say the first day of the month goes up. And then the second day, when we get that separate opening, so the opens, think of it, they're all like lined up like this, right? They're all stacked on top of each other. They're the same. And then that next day opens, we gain information. So if that day goes red on that second day of the month and then starts trading back in, taking out the first day's lows, you negate and change the monthly participation group from green to red. So anyone that bought that first day is now underwater. They have to be. Because if you took the offer anywhere in that first day of the month and you're trading below it, they're all in losing positions. So they're going to stop out and then you get that move. And this happens on every time frame. So let's say the first week of the month trades higher. And then maybe on that last day of the week, you get that signal that makes a shooter on the week. Well, that second week, when the week and month opens decouple, you get new evidence. So they're either going to reconfirm the first week and gun it back to the highs again, or they'll negate, taking out that low, changing what you know, and then boom, everyone gets killed. And it goes whomp. And then everyone's like, whoa, it's going too fast, going too fast. And that's where we're trying to trade. So this happens across every time frame. The first 60 of the day and 60 opens are the same. So it might trade higher for 60 minutes. The second one opens, then whomp, takes them all out. So when we say that, we want to see our trades where we take the signal, it breaks. And then that's not the whole trade. It's not like, oh, we'll take it from the weekly target to here for 4%. It's like, no. We create the position on the weekly signal. And then if the next week opens and goes 2 up again, it reconfirms. So we add to it and then it keeps going. So confirm or negate. When you get an inside bar, so you go inside that previous range, that's potential confirm or negate, which is why we're seeking those out. Because that inside bar will either break up or break down, which either reconfirms what was happening or negates what was happening, depending on the direction of that previous 2 or 3. So if you have a 2 up and then it goes inside and then breaks up again, still going up, reconfirms. If it's going 3 to the downside and then goes inside and then breaks up, that negates. It was 3 down, going lower, inside, and then breaks up, negating what you know. And this creates losing traders. Because if it was going down before, now it reverses, they're losing. So that's what we're looking for. I hope that makes sense. We go a little bit more in depth, but really that's the gist of it. So when we're looking at multiple time frames, we say each move will either be confirmed or negated. So if we go on, SPY here. Notice the 2-2 week occurs here at the beginning of the month. At that point, you'll see the month, the quarter, the week, day 60, they're all red. The other thing is, since we opened the new quarter, the month and quarter opens are the same here. You'll notice they're the exact same level. So we have less evidence. They go 2 down on the week, 2-2 reversal, negating what was previously occurring as it's now going lower. Then they reconfirm the reversal week here. And at that point, we know they're selling. They sold here and then came back to sell more. So they have more to sell. And then here, puke. And then notice here they go inside week in green. That's negating what we know to be true. It's not negating trend, but it's green. So it changes what we know as the weekly participant is now buying, and that's occurring with the yearly participant. So the week, year, and then you'd say the day and 60 participants, they're buying this week here. And then they do break 2 up, which negates what we previously did. So they go inside, negating, and then inside up, that negates 2-1-2 reversal. So they were going down, now they're trading higher. When this inside bar is occurring, we can't say it has like negated trend yet, but we can say it changes what we know. Then the new month opens, and the month open separates from the quarter open here. So notice, anyone short during this quarter, they're short while this is going up because this is still red. So we look to stop those guys out above this. And we can do that with the weekly hammer actionable signal on the new month open, negating what the first month of the quarter did, and then boom, takes them out. And then you'll see they trade up, 2 to the downside, negating what we know to be true. It hits its weekly magnitude, good. Then it starts recovering with the day and 60 groups going green in here, setting up a hammer week. So it's much closer to going full time frame continuity, 2-2 reversal week here. So at that point, we look to go and buy. Every time frame's green in here, right there. We just buy it. Boom, up they go. And you can see 2, 2, 2, 2, 2, 2, 3 to the face, get out. So from here to here, and maybe you got a bad exit, 4%. And then from here to here, for another 4%, let's say 3%, et cetera, and then even the shorts in here, you can see 4%. If you're late, 3%, et cetera. So when the moves go like this, where you can see 3-2-2 week and then 2-2-2-2, this is where you make the money. It's not the reversal here you're making the money on, it's all of this, which is why we say you don't need much to make a lot. Because if you got this in here on the 3-2-2, which we posted on Twitter, when this occurred, you can go and fact check me, or on this 2-2 week, on the second week of the year, decoupling from the year and week timeframes, you killed it, right? Killed it. And then you can even play the inside bar ad if you're about it. You'd have to get out of here, but hopefully you see what I mean. we've beat that horse dead. So I hope that all makes sense. But with that information, you then want to reconfirm weekly signals, monthly signals, quarterly signals, yearly signals on lower time frames with reversals, with continuity. Let's take a look now. So position sizing, layering in, layering out, depends on what you're trying to do. Most traders are too scared to put a lot of their account in one trade. We are not. If you are in a trade and you have full time from continuity, you got 3 signals in force, you have every reason to believe it's going, you can buy a lot on that. And the reason you can is because our stops are so tight. And our risk reward for those people that track it, it's a stupid metric to track. I'll just tell you that now. But so like for example, financials. This inside day broke with the weekly signal in force, with the monthly signal in force. We have no reason that's not going to work. And every financial name was doing that, including all the Bitcoin names in the financial services. So when this breaks on Thursday, we can just buy it here and our stop goes here. So you're risking 14 cents, 0.32%. So if you have a $10,000 account, if you wanted, you could put all 10 grand in there, right? At the worst, you lose 0.32% of your account, which isn't much, right? So we want to take the tight stop trades with a lot of evidence and then hold them when they go. Because if you have a $10,000 account, there's 5% on the account in, 5 days, 4 days, 6 days, my bad, because it went over the weekend. But 6 days, and then if you get in here, 3.5% if you're just trading that daily trend reversal against you. So hopefully that makes sense. The more evidence you have, the more you can add or have in your position. The other thing you can do is, like we already talked about with setting up signals, that's where you like daily signal, enter, go a little smaller. If you have a $10,000 account, maybe you only put like $600 in it. And then the weekly signal breaks, that $600 is now $1,000. Now you have $400 of their money to play with. Maybe you add $1,500 into it because you're playing with their money. So what I'm trying to get across is if your level breaks here, and then you're in, and then you set up new signals or you're triggering new signals, you can take it here, trades up into here, sets up the new signal, and then it breaks again up in here. This is your first entry. This is your second. The midpoint of that would be if you doubled your position size where your break-even stop is. So you can enter here, add here, you can double your position, and then your midpoint break-even stop is still break-even because you already had a winning position. So you create the winner, add to it, keep a break-even stop, and then the ones that really go, you have the most of your account in that trade. Unlike other traders where they go really big and then partial when things work in their favor, since we know how to gauge when things are going and when things are reversing, unlike everyone else, we look to add. Because if you bought this financial and then it goes 2 up and you add to it, and it goes 2 up and you add to it, and then 2 up and you add to it, 2 up, you add to it, and then it reverses here and you get out, you could make your whole year just trading just this. So when things reconfirm and continue doing that, we want to get more. And you can either do that on continuations or you can go on lower time frames and continue to add. But I hope that makes sense. It's going to be different for everyone as far as what you get in the groove of. Like some people simply will just see a monthly signal, they'll buy it, throw a lot in it, and then if it works, good. If it doesn't, take a % loss and so be it. Other people like me, they'll be in there on like 30, 60, 15 stuff, trying to create a position with like a 20, 30 cent stop and then $10 and you make it all. And this is why we say it's not the win rate that matters. Everyone always asks, like, what's the win rate? It doesn't matter. I've never tracked it myself. What matters is, do you hold your winners? Because those are the ones that truly pay you. The slight losses that are 20, 30, 40 cents, they don't matter. They don't change anything. That being said, let's take the next one. Favorite and least favorite strat combination to trade on the daily and weekly time frame. 322, super good. The 122 rev strat, super good. The inside bar, 3-1 or just 2-1, super good. Those are the things I'm looking for. That pretty much covers everything. The other thing you can look for is like 3-2 reversals, which are a little more uncommon, but like something like Marvel here. 3 and then 2 reversal here and then get short. And you can see, like we're saying, just how small the stop is. 31 cents, and then boom, $5. And then it keeps going because at full time from continuity, 60-day, week, month, and quarter all red in here. But hopefully you can see what I mean there. So that answers that. Managing your winning position when swing trading versus day trading, kind of already covered that. But are you partialing or exiting on a daily against when swinging for monthly targets, even if it's nowhere near taking out your entry? So what matters is how much evidence do you still have? So if you are trading, let's just say we're trading SPY. If you're a yearly guy trading SPY, if this year is green, you can stay long. Now, When do you want to protect your position? When the quarter and the month start going red and taking it two to the downside or two going three down. So you'll see in here, right when the quarter flips red at the top, right? That's when you buy puts if you're going to hedge your position. And then puts, boom, they pay, right? And then once that starts changing, you can see the month flips green in here. That's when you start getting more of that position and adding to it. And then you can stay long. You got the quarter, the month, the year, all in your favor. Boom, boom, boom. And then here, the month starts changing with the week. If this were to go like 3-2 next week below this, that's when I would want to have puts, if you don't already, on the 2 up red to go 3 week. We also have things like Qs where you're going to see it gets 2-2 week and then changes the quarter continuity. This is where you want to hedge. And the reason you do that is because when you have full time frame continuity, the day, week, month, and 60, or ideally the quarter and the year, but at least the quarter would be good, that's when the market can crash. And the reason that's good to know is because if you go back and look when the market crashes and comes down, boom, full time frame continuity, shooter week, down goes Qs. If we go back to COVID, you can see right up in here, they change the quarter to red, then they go inside down, boom, down goes Qs. You go down in here, so the continuity changes up in here, then down they go, etc., etc. And then when it changes down here, that's when you get back long. So it depends on what your basis is, but we use continuity. Depending on how much of a stickler you want to be, you can also use signals. So like if we are a weekly guy and we get this weekly hammer signal here, when this is going up, going up, going up, when this goes red and then starts coming back in, trying to go last week's lows, reduce, right? Or keep your stop break even. Because you have the week, or not the week, you have the month, the quarter, the year still in your favor. When that week breaks down, you don't have much evidence that's actually reversing. You just have the 2-2 week for 1 week. So once the next week opens and it firms up by going inside bar, you have nothing to worry about. You can either add back or you can add to your position after keeping a break even. What matters is when this 2-2 occurs here and everything changes, this continuity changes, that's when we'd start reducing this and reducing this position. Because at that point, we don't know. That could really follow through, especially if we start going 2 down again next week and reconfirming that. So I hope that answers your question. Continuity, super important to that. And then also, how long do the signals last? Like, do you have a yearly signal in force all year? Hold it. Do you have a monthly signal the rest of the month? You can hold it unless the week starts changing, etc. So hopefully that answers your question. If we go to the next one, quickly drawing the Broadening formation, we draw right to left because the Broadening formation is not based on current range, it is based on previous range, which makes it a pattern that has bearing on price action because the pattern can be identified before it completes. Unlike a head and shoulders or a pennant breakout, which you cannot identify before it completes, a Broadening formation is always going to be on the chart before it completes. So what I mean by that is we look for the last lower low. We can say this is a lower low, right? And it took out all these lows in here. So we draw to the previous lowest low that is still higher than this. So slight lower lows here. Then notice you'll have a slight higher high to this. So we can draw right to left like that. There's a try. We can also, as price starts making it bigger, redraw from right to left, redraw from right to left, redraw from right to left, redraw, redraw, redraw. And then when this 2-2 occurs with continuity, now we know it's changing and we can gauge the size of that range if they're going to come back in. The other thing with broadening formations is you can simply scan for them, scanning for threes or looking for threes. So when you have a 3 here on the weekly Qs, that's a broadening formation. So you can draw this out. So you can see the range expands, 3-2 to the upside, redraw. Then it pokes up and comes back in. That's a problem. 2-2 on the week, where's it going? Down there. They missed it. I don't even know if they missed it. Yeah, so they took it out by 12 cents. There's your magnitude to the pennies almost, right? And the other thing is when you're drawing broadening formations, every reversal creates a broadening formation. Every consolidation creates a broadening formation. So when this goes 2-2 reversal week, these 2 bars go outside of this. There's a broadening formation here. And you're going to go nuts if you draw every single one out. But it's important to know that price goes outside the previous range. And drawing them from right to left, it's a skill you will learn. But just understanding it occurs and when continuity changes and starts coming back through a previous range is 90% of it. If we go to like DE, this is a very solid example. Notice you draw from the highest high right to left, like so. Slight higher highs to this. And then the lowest low before that low formed here on the week. Slight lower lows to this. Here's your try. Slight higher highs, slight lower lows, boom, slight lower low, back up. And then notice when that reversal occurs, it creates a sub try because any reversal also creates a broadening formation, which is why things will rally and then reverse and fly back through the range if you have continuity and strong enough for sellers in this case. If we go to something like CCL, show you another way. Another way to do this is using levels of reclaim. So just understanding, notice this 2-2 reversal here, these bars from this high to this low go outside of this bar. These are levels of reclaim. So when this pokes up and reclaims, we're going down there. Then it pokes down. We can redraw. We can also say, like, when this reclaims these lows in here, it's trying to go up there. Then it does. Then you'll see they reclaim again in here, back through the range, and they take out the lows here. So you can either do it as levels of reclaim, or you can get good at identifying the broadening lines, which they will point out the highs and lows a lot of times. And we call them true support and resistance because we know price broadens over time. It does not box, it does not pennant, it does not head and shoulders, it broadens. It's just how it works. So hopefully that answers your question. Learning the difference between TTO and reversal. This is in reference to time frame continuity. And we do have a thing I'm going to pull up here. Give me one sec. So I already recognize this video is going to be very long, but what I'm going to give you guys here is a snippet of what we talk about in the course. So we're just going to go and play it from here, and we talk about exactly this. This is one of, I think, like 13 sections. So I'm going to give you guys that. We'll see you in a sec. Got to stay up there, or you're going to try and come back through. So hopefully that makes sense, and you'll see a lot more of this as we get into combining signals, and it's going to be in tomorrow's lesson. But the last thing here is then talking about the TTO, or the triangle layout, and corrective activity. So first we're going to cover what is corrective activity. Then we're going to have a little visualization of it, which we've talked about previously. And then what does TTO mean, which is triangle layout, and then higher time frame signals plus TTO example, and then TTOs to create signals, which is getting a little bit into what we'll talk more about tomorrow, but little introduction towards the end. So what is corrective activity? What's corrective? Corrective activity is going to be a reversal against a higher time frame period of control. So when we identify continuity, we're identifying who's in control. So if the day, the week, the month are all green and the 60 is red, that's triangle out, because at that point it's too conflicted. It's only the 60-minute basis. So that would be an example of corrective activity against a period of control. 3 time frames up and then 1 time frame down. A triangle out, or TTO, is a way of identifying the lower time frame broadening formation. And this is how we incorporate the second universal truth and the third, continuity plus the tri. So this is a visualization of this, and it's called TFC bars. We've already gone over this a little bit in the continuity section. But what we'll see is they provide the strong period of control, and then you get corrective activity, where the 60 is the only group countering the day, the week, and the month. So this is the period of control. It's going down. This is by definition corrective. It's got to be. So what we'll notice is the triangle, or the TTO, is occurring in here. So they go into recent lows on the 60s. Then they gap up, making slight higher highs to the stuff on the left. And then combined with the 2-2 reversal on the 60-minute, we can see the broadening formation, where they take these highs out, failing back into the range. 2-2 reversal. Now we had corrective activity and now a reversal. So anyone was long in here, we're going to try and get them out with full time from continuity down. And then you'll see all 4 of these bars become an outside bar to all these bars left right in here. So they triangle out, stopping people out, and then back down. And the same thing happens in here. You'll notice the 3. That's a triangle. They go inside, and then slight higher highs still inside of the 3. And then the rev strat, 1, 2, 2 here. And then that gets you out of that mother bar. So when you're timing the broadening formations and lower time frames on like a 5-minute chart, this is a 60, on a 5-minute, you'd have the broadening formation in here. Because you'll see they went up, went down, went back up, and then all the way back down. And then similarly, if we zoom in even more, we have some triangle outs in here. We had the new open of the day, 3, broadening formation. They poke up, they go inside bar. And then you'll notice they go inside bar down, changing the day to red, the week and the month also still red at that point. Full period of control here, back through this 3, broadening formation. They take them both out. And that's going to continue over and over. And then you'll see they change the period of control here. And at that point, continuity has changed. All these 3 time frames are confirming each other. Now price is trying to go higher. So you can see the periods of corrective activity or triangle layout. It's when you have this 1 time frame countering the 3 time frames here. There's also very slight green days in here. But as far as we know, when those 60s break back down and the day goes back red with the 60 red, whoever is buying to start the day, they're out here. And similarly, whoever is buying to start the day in here, they're out here. So hopefully you guys can see that visualization, and very, very good with combining continuity and seeing the triangles. But the next thing, TTO means triangle layout. This is a broadening formation. So what we mean when we say this is whoever was long or short before has now been stopped out. And thus, we can look to take a position on a reversal back into continuity. And the reason we call it a triangle or a tri or a broadening formation, specifically a triangle though, is because we can draw the tri. We can say they longed in here, up into this stuff, and then they stopped them out down into here. And that creates, you can see the triangle. It's just another way of identifying the broadening formation. So when we get this 2-2 reversal back up, where is it attempting to go? Back up into the top of the triangle. So just another way of identifying that all. Hopefully that met you guys kindly and that makes sense. So it's again, just identifying the tri and looking for periods of control back through previous range with slight corrective activity. That's how you identify a triangle layout. The other thing you want to know is when you're into the top of the tri on bigger time frames or the bottom, that is where triangle layouts turn into big reversals. So you want to know where you're at in the broadening formation series on whatever you're trading. Because if you're expecting triangle layout and they're coming back below this previous high in here, and you're like, oh, it's going to stop people out and keep going. It's like, no. They just triangled out the big time frame and now things are changing. So very relevant. And as time goes on, you'll get more, get more comfortable with identifying like, well, is this changing what I know and coming back into a big previous range, or is this just stopping people out and I can stay long? So hopefully that makes sense for you guys. Sorry about this. I don't have the question here. I think the last one was identifying when it's going back through the previous range. Let me scroll down and make sure. Okay, so when reaching the edge of a tri in a broadening formation, what is the probability of reversing versus breaking out? Continuity tells you exactly what you need to know. If this is breaking out, the year will stay green and it'll stay 2 up. If it's not, it'll be a 2 up in red and change what you know. The beautiful thing about the strat is we know what a reversal looks like. So if you know what a reversal looks like, and you know what continuity looks like, you know exactly what's happening. So there's no guessing at the top or bottom of the range. You just let it tell you. Hopefully that makes sense. How to use previous candlesticks to identify compound 3. We kind of already talked about that, but what we're identifying is when things hit magnitude, they create a broadening formation. So when this 2 up, 2 down reversal hits magnitude, making a new low to this low, at that point, you've made a higher high and a lower low. That's a broadening formation because these 3 bars are compound 3 to this. So when it starts racing back through with continuity up, it's going up there. So you can see they do that. Then now, once this makes new highs, it made new lows. Let me clear this out so it looks a little less crazy here. So they've made the new lows. They start racing back through. They make the new highs. There's the top of the tri. These 1, 2, 3, 4 bars went outside of all these 3 to the left. There's your 3 of the 3. And then this pokes up and comes back in. There's your potential 3 again. These 4 bars become an outside bar of these 4, which were outside of this. Then you can see again, and then again, and it occurs over and over. Once you're up and out and you stay above these highs, that's when the expansion occurs. So we might even try this again in cruise lines. We'll see. But hopefully that makes sense. It's pretty simple. The other thing is what you'll notice, and the reason we identify it as a compound 3 is because on a higher time frame, this is a 3. It has to be. So like on a 1, 2, 3, 4-year basis that opens here, this is 4 years outside of the previous 4. That's a 4-year outside bar. The charting platform just won't show you this. So that's what we're identifying. Someone said how to narrow down the best setups. Best setups will have full time frame continuity and actionable signals through a previous range. That's how we narrow it down. It's that simple. So if you go and look at the previous weekend video, something like PayX, why do we know this would be such a good setup this past week? Well, it had a big magnitude. If we go in here, time frame continuity, had a big magnitude. The month, weekday, and 60 went green, when it traded above the month open here at 119. Therefore, it goes to the top of the broadening formation, gauging the magnitude, 128. And then that's also where I exited. I literally sold right up in here. I could have flipped short if I wanted, I just didn't. But that was also another 260%er. So that's how you narrow it down. As far as narrowing it down between the whole market and the sectors, what you're looking for is where are the most twos sector wide. So like if we're going to short, let's say we were shorting last week, where are all the two downs? That would tell us what we're going to do. So we can use the indexes first. We can say, well, Qs, semis, communications, tech, it's all the technology stuff, including semiconductors. So we go and short all those. So if we go and look at the sectors in tech, we can scan two down. This will have the best short trades because you have the most going to the downside. And what you'll see is anything from the weekend video, go to KLAC, boom, killed. LRCX, boom, killed. If you go to MU, killed. And the other thing you can then do is gauge relative strength and weakness between the setups. So if we go to semis, SMH, if this is setting up 3-2 up in shooter, which we identified as a short below this for 14 bucks, then anything inside weak in the tech or the semiconductors, is tech also had this shooter, anything inside bar is weaker as it did not trade higher the previous week. So when you go to MU, this is relatively weak as it's an inside bar. And if you go and watch last week's weekend video, we mentioned that specifically and said, we don't want to buy this. It's nowhere near last month's highs. We're going to short this down because it would cause the 2-2 reversal month. And that'd be coming from the top of the range, pairing that broadening formation, which you can see they did expand it, but now they're reversing here. So we can redraw like this. Here's the new try once that starts reversing. Now, since that's occurring up here, we have a lot of range to go. So we create the position, then we just hold. We got all month, and then you got the rest of the quarter if it goes below this. And then if it negates the year, you got a rev strat year if it gets way down here into 84, which we'll see, maybe, maybe not. But hopefully that makes sense. Gauging relative strength and weakness using inside bars. The other thing a lot of people do is use outside bars. So like, for example, in the transports, or we'll go industrials. No, yeah, we'll go transports actually. So transports, to start the new month, they go inside 3, which shows aggression. They're willing to sell it down and buy it up. It's a broadening formation. So we can say the buyers in here are aggressive, right? They slammed it all the way down in here, and then the buyers stepped up all the way through the previous range. So the next week opens, if that's 2 up, that should be one of the really strong ones. And this is where you get the really big like explosions with the 3-2s. So we can use things like, for example, Tesla as an example. You can see when Tesla rallied, what did it do? The 1-3-2 rev strat. Boom, 3-2 expansion, and up they go. And the reason that happens is because the broadening formation, it'll bounce around, and then once it starts expanding, that's when it explodes. When we identify an inside bar, where it's just really small range inside that previous range, within that, inside bars start new broadening formations. So when that inside bar forms, it's a micro little try on a smaller, maybe if it's a weekly inside bar, you have a 60 try. So when that inside bar breaks, it's also an expansion, but it's breaking equilibrium. It's not breaking a 3-2. So it's a different condition, but it's a similar, I guess, expansion of a smaller broadening formation. So hopefully that answers your question as far as how can you narrow it down, gauging relative strength and weakness, as well as the simultaneous break, most twos in your favors across sector. And I had a specific one talking about SLB, rejection of, let's see, after the top of the broadening formation was hit, see if expansion will take place, SLB on the daily. So I imagine this is what you're looking at as your try. And each day we would redraw this if we had to. We didn't need to until it made this new high. You draw it to here, and then to here, and then to here. And then they close up and out of it. So this is where we leave it. It turns into expansion once you close outside the range. What you can see in here is they did not close out. They did not close out. They did not close out. They actually close back in. Then they close out here. So if it's going to be expanding, it's got to stay above that. And that's how you can gauge, is it expanding or not? And if we go to, like, for example, back in here, you can see slight higher highs on the day, slight lower lows. So shooter day from the top of the try here. It's probably going to occur with full time from continuity because it worked. Yep, so you can see full time from continuity, short, boom, back through those guys. And then notice how it closes out. Now it's in expansion. This range is getting bigger. So they do try and break up, retesting the bottom of the try, right? A lot of people, they'll think it needs to retest this level, but we know true support and resistance is broadening. So right here, Then rev strat, setting up off the 60s, I imagine. And then it stays out still, good. Sideways, down, stays out still, good. And then you create a new 3 in here. So if it reclaims this 3, that's when you start taking profit, right? Because you're back into this big 3. So they do, and they come back up. Then you get the rev strat. This is where you can try and get back more short with your running position. Add back into it, makes the new lows, bottom of the range. And you'll notice, did it expand when it made those new lows? Made the slight lower low, and then notice back into the range. That's where you'd start reducing, then it's back through. Then you can see this go into expansion. They did test it again, then they kind of chopped around, then 2-2, they now are closing back into the range. That's when you start reducing this stuff down here if you're playing it. And then they start that new try, etc., etc. So just looking for it to close outside the range, continually redrawing until it does that. And the reason that's important is because broadening formations get bigger. So if you go to like something like the SPX on the quarter, you're going to see how that works over time. So you get the slight higher highs, and then you have the '08 crisis. Did we know? We would have. If I was, not 6 years old at that time. Yeah, about. So bottom of the try, and reversal, boom, top of the try. Close out, boom. Keep the try drawn. Any positions taken in this range, you're long, and you have a break-even stop, because it shouldn't come back to that range if they're going to keep expanding. Then you get a small triangle out in there. Here's the low of your 3, slight lower low, rev strat on the quarter. And you'll see, depending on how you're drawing this, we could just draw it as levels of reclaim, but they close up and out of it, stay up and out of it, and then expando. Then they start a new try in here. And you can see they try expando, 2 up in red, back into the try. Where's it going? Other side, boom, COVID crisis. Then 3, 1, 2 expansion of the 3, expando, boom, 3, new broadening formation, gets bigger. This caused an outside on the year. Here's your try. And they start reversing back through, up they go, and then now they're out of it again. And we can either leave it drawn or we can continue to redraw. Once that continuity changes, then we can draw it off those highs. But until the continuity changes, what we'd say is it looks something like that. So hopefully that makes sense. A really simple way of doing this is, and I don't like to say it, but breakout traders, what we say is the breakout will either be successful or fail. And most people don't say that. So the broadening formation, this 3, if you break out of that and stay out of the 3, it's expanding. If you break out and reclaim it, now you're back through it. So really simple stuff. The same way that it breaks the low of this 3 and then it's back in, let's go the other way, right? And it makes the slight higher highs in here and then reclaims this high, let's go the other way. Lower low, reclaims the low, go the other way. So just keep it nice and simple. But that's going to cover all the questions. So I hope you guys enjoyed this. If you want more videos like this, let me know, and maybe we can make this a thing we do every weekend. We could also do it live if you guys are interested. Let me know in the comments below, and I'll see you guys in the next weekend vid. Part 2 coming out probably later tonight. We'll see. But I hope you guys have a good rest of your Sunday, and we'll have a great trading week. Adios, and have a great one.